right, let's get this afternoon going. Thank you for coming in after the lunch break. It's always like herding cats. I know you all want to network and talk to each other, but we have a very special and very, very impressive person on the stage next, Demelza Hayes. She is the head of research at Cointelegraph. Among many of the other titles that she holds, she is the co-chair of our investor working group at CVA, and she's also a brainiac at Zeltner Co. I actually don't know your official title there, but I'm sure you will mention it. I will give the floor to Demelza. Thank you so much. And let's give her a big round of applause.
Thank you, Nikki, for the warm introduction. So as Nikki mentioned, my name is Demelza Hayes, and I'm no longer the head of research at Cointelegraph, but he is around here somewhere. No problem. I'm the chief economist at Cointelegraph, and I'm also a portfolio manager at Zeltner Co, and that's a FINMA licensed asset manager in Zurich. So today, we're going to be discussing market making for Bitcoin and the problem of phantom liquidity. So during this presentation, I'm going to start out with talking about global adoption of Bitcoin and some of the obstacles that are standing in the way of Bitcoin being used as a medium of exchange, unit of account, and eventually as money. And then I'm going to discuss how flash crashes happen, what we've seen from the cryptocurrency market, and I'm going to discuss the unique solution that Zeltner Co has designed so that we can provide real liquidity to the Bitcoin market. So if we talk about trading volume, what we see currently for Bitcoin on spot markets is that we're looking about 10 billion to 20 billion per day in spot trading volume. Now, this isn't the whole picture, of course, because we've got a lot going on with OTC desks, and we don't know exactly how much is happening with the OTC desks, but what we can see is that we're not quite we don't have as high of a trading volume as we did back in the last peak of the market in 2021. But one aspect of Bitcoin's adoption is having a stable purchasing power. So, for example, if you have let's just imagine we have a standard that's based on gold, and everything at the grocery store is priced in gold. So if you go and you try to buy a gallon of milk, and today it's 1 gram of gold, just as an example, and tomorrow it's 1.05 grams of gold. The producer of the milk doesn't know if the demand for milk went up or the demand for gold went up, right? So if the producer of the milk thinks, okay, the prices are up, I should produce more. He then goes and buys more cows, hires labor, and gets more land, produces more milk. Then at the end of the year, maybe he realizes that actually the price of milk only went up because the demand for gold went up. And then there's a misallocation of capital. So one of the key things that we need from our money is actually to be like a non-noisy surrogate of information to entrepreneurs that are deciding how to allocate capital. So this is going to give information from demand from consumers to entrepreneurs that are providing goods and services to the economy. And if we have noisy signals, which is what we have right now, right? We have fiat currencies that very noisy signal of what the real demand is behind, because we don't know what is caused by inflation versus what's really caused by change in demand. And this is where the misallocation of capital happens. So one thing that's stopping Bitcoin from being globally adopted as a medium of exchange is this volatility, right? So if we really want to come in and change that volatility, we have to look at the liquidity. Now, in terms of volatility, we have been coming down. So even though our spot market volume has not been increasing, our volatility has been decreasing, which is putting us in the right direction that we want to go if we're going to see Bitcoin as a global standard and reserve asset. So we used to be around 100% annualized volatility. Now we're down around 50%. So maybe one would think, okay, there's sufficient liquidity. If we look at the spreads for Bitcoin in the US dollar spot market, they're as low as 0.001. So we can all pack our bags and go home because the problem's been solved, right? There's no more volatility, the spreads are tight, but that's not the whole story. That's only if you want to sell one Bitcoin. If you want to sell more than that, you're going to find out that the spreads are a lot larger than what they are at the top of the order book, okay? So, for example, if you look at the euro US dollar market, you can move about $100 million instantly within about 0.02 to 0.03% of the market. Okay, now who thinks you can move $100 million worth of Bitcoin right now without moving the price? Anyone from Hidden Road here? No, it's impossible. It's impossible. Right now, if you try to move $100 million in Bitcoin, you're definitely going to impact the price. So what we see with Bitcoin, if you look at Kraken, for example, if you look at Binance in the top row, right now, minus 2% is around $16 million. So if you put in $16 million worth of trades on Binance for USD Bitcoin spot, you're dropping the price by 2%. So in terms of liquidity, the euro dollar market is about 40 times as liquid as the Bitcoin US dollar market right now. So we have a long way to go in terms of actually having real liquidity that's there in case people do want to sell. If you were to put this in comparison to the euro dollar market, you would have to move about $2 billion to have the same effect as moving 50 million in the Bitcoin market right now. So another issue with the liquidity in the Bitcoin market is that we don't know how much of it is real liquidity, right? For example, Forbes did a study last year and they said that about 50% of all orders in the Bitcoin spot market were fake. Okay, so when they call by fake, they mean done by other market makers and not done by retail investors that are looking for economic activity. So in history, what we saw on the stock market is that when market makers were pushed out, we would have flash crashes. Okay, so for example, there was a 2010 crash, it's quite famous. My doctoral supervisor was the chief economist at the Commodities Futures Trading Commission when this flash crash happened, and subsequently in 2015 when another flash crash happened. And the Dow Jones Industrial lost about 9% in 3 minutes. And when they went and did an analysis of what caused this, they found that there was a gentleman who had created a whole wall of basically spoofing orders that he had planned to cancel with about 19,000 trades. And the goal of it was to manipulate the price in the direction that he wanted it to go so that he could profit. And I think he made about $40 million off of that trade, but this was $1 trillion loss for the market. So what we really need with Bitcoin is market makers that are there to stay, that they're not leaving when there's real volatility. Okay, so for example, like the March 12th, 2020 crash in Bitcoin when we lost double digits within hours, a lot of market makers left the market, right? And that's why at Zeltner Co, we've created a strategy where we are always in the market. So just to talk a little bit about our strategy and how it works, it's a very simple approach. So we have 70% allocation to Bitcoin, 30% allocation to US dollars, which are stored in treasuries. We have a risk-adjusted exposure, which I'll explain shortly, but basically that's because we're not fully invested in Bitcoin. And we collect a volatility premium because we're doing about 800 trades per day, where we're constantly rebalancing and doing a couple million per day on Kraken in volume. We have low costs, so we are priced like an ETF. So we're actually priced less than the Valkyrie ETF already, and we have no performance fee. And we're priced this way because we want to attract liquidity, because we cannot actually smooth the volatility in the Bitcoin spot market unless we have sufficient assets under management. We also have very affordable custody fees, so we're at 20 basis points per year at Amina, and that's due to our volume, which at this time we're managing over 50 million in this fund, in this certificate. So that's why we were able to negotiate fees that are much lower than if anyone just walked into Amina and asked for a custody account. Finally, we're also audited, and as I mentioned, Zeltner Co is regulated by FINMA, and they're based in Zurich. We have reduced counterparty risks, and the product is bankable, so you can invest in it with Bitcoin. You don't have to go into fiat first, or you can invest in kind. So just to explain how this strategy works, this is a very simplified example, but we start out with 70% allocation, and if the price of Bitcoin starts to fall, we rebalance and buy Bitcoin so that we're always back at that 70% allocation. In this example, it shows us getting down to 50-50, but we never get close to that. We rebalance the second we get down to 69.9%, for example. And this is how our algorithm works. So on the horizontal axis, we have different time periods. So this could be minute 1, minute 2, minute 3, minute 4, minute 5. And on the left-hand side axis, we have the price. So for example, if we started a price of $10 per Bitcoin, as the price of Bitcoin goes down, we trigger one of our orders that are sitting in the order book waiting to get executed, waiting to get filled. And then on the upside, as Bitcoin starts to go up in price, we sell. We sell into that pressure. And over time, this allows us to collect a volatility premium because we're always buying low and selling high, which I'd be happy to discuss more if anyone has questions. But this is basically how the systematic approach works to providing liquidity. And the result is that our distribution, our return distribution, is slightly narrowed compared to just a direct investment in Bitcoin, because as I mentioned, we're only 70% exposed. Plus we have the 30% allocation to cash, which is earning 5% right now because it's invested in treasuries. Then we have the volatility premium. Now, you can do something like this on Kraken and on Binance. They'll take your funds and they'll lend them out to people, shorters, people doing the perpetual futures, and they'll pay you 10 basis points to 30 basis points per year. But you're buying a whole nother risk when you lend them your coins in these earn programs, as we've seen. So if you read the terms and conditions, it's no longer your asset. So if they go under or anything like that, they don't have to give you back your funds. So it's a totally different risk versus the return that you're getting. Now, in addition to our strategy making the distribution narrower, we're also shifting it slightly to the right because we have the volatility premium. Now, just to kind of give an example of what this would look like in the long run, this is how we came up with our benchmark. So for example, if you look at the left-hand side, this is the spot of Bitcoin, sorry, the price of Bitcoin, and this gray line is basically your return from investing in Bitcoin. So if you look at the black line, for example, if Bitcoin drops in price, you would get the black line return, and ours is the green line, so we would have basically, ours is the two pink lines. So you would have less of a maximum drawdown with our strategy. On the up-hand side, if Bitcoin goes straight up, we won't outperform Bitcoin because we're only 70% exposed. But now, if you imagine that Bitcoin has an S-curve of adoption, eventually our strategy will catch up, right? Because over time, as Bitcoin starts to plateau, our strategy will still earn the market-making premium. So for example, in the last 2 months, we were able to outperform Bitcoin and generate volatility premium, which will help us catch up when Bitcoin has a large move upwards. So the main idea of this product is to really be a buyer of last resort for Bitcoin, to always be in the market, and to actually smooth the volatility of Bitcoin. And if we can really achieve that, then that will unlock one of the obstacles that's stopping Bitcoin from being used as a medium of exchange and unit of account and eventually a money. So if anyone would like to join us in that journey, I'd love to speak with you afterwards. And if anyone has any questions, I'm also happy to have your feedback. So thank you very much for your attention.
Maybe we have a minute for a question or two. Anybody would like to ask? Any questions for Demelza?
So that's a great question. So if you were to copy paste our algorithm across the whole order book, and you wanted to smooth the whole order book, we would need about $8 billion in today's current prices. Now, of course, as the price of Bitcoin goes up, we'll need proportionately more. But right now, at current prices, we need $8 billion to smooth Bitcoin across the major regulated exchanges and trading pairs. Yeah. But thank you for the question. Yeah.
Thank you so much,
Thank
Demelza.
you.
Appreciate sharing all this knowledge.
Thank you.